Afternoon, ladies and gentlemen. It's Eric Coffin. I'm here at the September 2019 edition of the Metal Investors Forum in Vancouver. I'm here with one of the companies I invited, Minera Alamos. More specifically, I'm here with Doug Ramshaw, who's the president of Minera Alamos. Minera is unusual in terms of the companies that I follow. I do follow a number of developers that I follow through exploration, but in most cases, I'm following them on the assumption that they're going to be taken over. That's sort of the end game. Minera is one of the few cases where I started coverage on a company where I knew that their plan was in fact not to be taken over but to go into production, and I did that because of the belief that I have in the low capex model that Minera has for gold production, and also the faith that I've got in the management team to execute. Can you kind of give us the 2 or 3 minute capsule version of Minera Alamos, Doug?
Yeah, absolutely, Eric. I think, much as I hate talking about historical events, it's very important for the context of one of the reasons I think you looked at this story. We specialize in low capital intensity projects, but more importantly, we don't need to define all the ounces up front. And Darren and the team were behind the Castle Gold success. In 2008, they built a 25,000 ounce a year operation for $6.4 million US. And it was really based off a starting resource of 300,000 ounces. They then expanded that out of cash flow, and by the time 2 years had passed, Argonaut bought them for $130 million. They quadrupled that resource, and they'd expanded the production profile twofold, but we're heading to a threefold increase in that, and they did that all out of cash flow. We feel like that is a very shareholder-friendly approach to exploration, and at the same time giving all the benefits of a gold market when you happen to be in one, for the gold production side.
Well, and that's one thing that's worth noting. I mean, one of the things I really like about Minera is that, obviously, like any company that's going into production, and I believe your goal is 100,000 ounces in 2 years.
Yeah, a couple of years.
Kind of obviously, that in and of itself gives it upside, and obviously, if the gold price keeps rising, there's going to be great leverage to the gold price. But I think it's worth noting, you hear heap-leach, bulk tonnage, grade, low capex. You sort of immediately think some kind of a shoestring, but the truth of the matter is, you and the board made the production decision and stress tested everything well below where the gold price is right now.
Yeah, I think, we stress test everything at 1,000 ounces. I think gold was $1,250, $1,300 when we were talking earlier in the year. But yeah, everything's stress tested at 1,000. The second asset that we're looking to bring on stream in year 2, La Fortuna, again, we used $1,250 in the model. We stress tested 1,000. We're talking to a bank in regards to the debt component on that modest capex build, and they tell me they can't break the project, and in many ways that's what we want. We want a business model that is not predicated on needing higher gold prices. All that increase in gold price goes directly to the bottom line and to our shareholders' benefit.
And part of the key to the low capex model here, and what attracted me to it, and the reason why I bought it and initiated coverage, was essentially from going forward, your plan is to have little or no equity dilution from this point forward. You think you can debt, royalty, whatever, but not share issuances, and then once the first one gets going, you use that to leverage borrowing and or just to use the cash flow. You're not planning to issue a bunch more stock, essentially.
No, it's fair to say, and I'm going to pick on Manitoba now, but I always say if we were exploring moose pasture in Manitoba, and you had 376 million shares out, you've got a problem with your share structure. As a producer, we're a market cap story. That being said, we're not going to be foolhardy in regard to share issuances as shareholders ourselves. Darren and I have bought almost $1 million worth of stock out of the market. In his case, half of that over the last four years, and me in the last year since getting involved. We are shareholders, so we don't want to dilute ourselves like any other shareholder. So the foundational dilution has taken place to build this asset base. So we're very comfortable that the bulk of the dilution is behind us, and we have a business model that is designed around trying to avoid dilution.
And normally, I mean, it's worth noting, I mean, you've got essentially all your permits for both of these operations. Those of you that are familiar with what's known as the Lassonde curve, which is this classic valuation curve for exploration/development companies where they rise up when they make discovery, fall back when they get boring and they're designing the mine and stuff, and climb again during construction, going into production. You're pretty close to the construction start now. You're very close with Santana. It's not very far out now.
No, that's November, and you're right. Like that's the part of the curve you want to be in, and in tough markets, even in good markets, the bottom of the Lassonde curve is not a good part to be in.
Yeah.
And in tough markets, it's compounded. So we're actually coming into a great gold market, I think, right at the time where we're not just going to crest onto that Lassonde curve, but because we're a multi-asset company, I think we can amplify the effects of that production end of the Lassonde curve, because it's not just one project coming on, there's another one coming the year after. And so we have this organic production growth, I think, that will really compound the benefits of being where we are on that.
And it's worth noting too, because if you're building a mine that's large scale, or where you got to put a lot of underground workings in, or there's infrastructure challenges, the timelines can be anywhere up to 3 or 4 years building a mine. But it's one of the things with Santana is your construction period is actually very short. It's not going to take you long to get this thing going.
No, it's about 6 months.
Okay.
We're planning to start in November after the rainy season. It's about 6 months, probably because of the overlap with Christmas. Is it going to be 6, or maybe is it going to be 7? I think more importantly, over the next 4 to 6 weeks, now that we have the permits in hand and we get the funding in place, I think people, whether it's 6 or 7 months, will realize this mine is being built. Right. And we become part of what is actually in the overall universe a small number of actual gold producers. And for me, I think there's no better way of playing the gold market than to be producing the damn stuff. And we hope to be doing that. And
it's worth noting too, in terms of shorter term than that. I mean, I realize this is the model that you and Darren built, but everybody loves a good drill hole, and I think it's worth noting that you've got a 10,000 meter drill program going right now. Mm-hmm. And some of that's probably, I don't know, condemnation, or maybe you got to fill in a couple of gaps, although I don't think there's many. You drill pretty tight spacing there. But a fair amount of that program is sort of new targets that you guys have generated in the last year or so, really.
Yeah, when we first did the deal, we always thought Santana was going to be the foundational cash flow generating asset that would allow us to take debt on when it came to the second mine. We now look at Santana having really got to grips with the geology over the last year, and it in its own right is way more than just that foundational little cash flowing asset. We see a production growth profile that can probably get to 60, 70,000 ounces in time. We made new discoveries last year at a time when no one cared. Right. And I'm excited now that we have a lot more people looking to start, that I think the kinds of results we put out last year will not be lost on them. Right. And we will be testing a lot of the new discoveries this year.
Basically with this setup you've got, and by that I mean the physical footprint that you've laid out and stuff, it's not a big problem for you to go to 60 or 70,000 ounces. Like it doesn't involve any like massive moving things around, anything like that.
No, I mean the big thing is just expanding the leach facilities,
right.
and because most of our targets are all within 2 to 3 kilometers of each other, a centralized leaching facility with that minor haul is nothing. So you'll have a series of satellite pits, right. likely feeding that centralized facility.
Okay.
Yeah.
Okay, we've thrown a lot of detail at you. Minera Andes, MAI, and the venture. Great story. Perfect timing to be a company going into production with not 1 but 2 mines over the next few years. Like I said, it's got great leverage to a rising gold price, but it's a stock that should actually do very well even if gold does literally nothing from here in the next 2 years, just on the growth profile and the revenue and the profit generation. Great story. Thanks for coming by, Doug.
Thanks, Eric.
Take a look.